Now, once again, to calculate the sustainable growth rate, but in a slightly more complex scenario, we have this particular situation from Ross Westerfield Jordan's Fundamentals of Corporate Finance. This is taken from chapter number 4, Long-Term Financial Planning, and the situation states, based on the following information, calculate the sustainable growth rate for Kovalev's Kickboxing. We have a profit margin of 9.2, we have a capital intensity ratio of 0.6, a debt to equity ratio of 0.5, net income of $23,000, and dividends of $14,000. So we have to determine what the ROE is over here. Well, in order to calculate the ROE, in order to calculate the ROE, we'd first have to understand what the SGR is, the sustainable growth rate. And to do that, we have to understand two further relationships that are identified within this information. First and foremost, the total asset turnover is the inverse of the capital intensity ratio. And so just to recall, total asset turnover is calculated as sales over total assets, whereas capital intensity ratio is calculated as total assets over sales. So it's safe to say that the capital intensity ratio and the total asset turnover are inverses of one another. That means that we can write this out as 1 over capital intensity ratio, first and foremost. And then the second thing that we need to understand over here is that when we look at the DuPont analysis, the equity multiplier as well is essentially the same as 1 plus debt over equity. And so the equity multiplier is equal to our total assets over total equity. Now, what we want to do is we want to connect this to our, in order to connect this to our debt to equity ratio, we're going to utilize our function of our total assets over here. And in doing so, we're going to fall back on our basic accounting knowledge, which says assets equals total debt plus total equity. So if total assets equals total debt plus total equity, then it's also safe to say that in this case, we can write out the total assets as total debt plus total equity. All of that is to be divided by total equity. If we break down this particular fraction, we'd get total debt divided by total equity plus total equity divided by total equity. This will be simplified into 1, and this will become debt over equity. So debt over equity plus 1 is the same as our equity multiplier. And these are the missing pieces that are going to connect all of this information to determining our return on equity. Now, falling back on the previous knowledge of the DuPont analysis, according to the DuPont analysis, ROE equals to our profit margin multiplied by our total asset turnover multiplied by our equity multiplier. Keeping this background information in mind, we now have enough information to calculate based on this given data. So that means we'll take a profit margin of 9.2%, so that's 0.092. Our total asset turnover is going to be the inverse of our capital intensity ratio. So that's 1 divided by 0.6. And our equity multiplier is debt over equity plus 1. And so debt over equity is 0.5 plus 1. We're going to go ahead and solve for all of this step by step. We'll keep 0.092 as it is for the time being. And 1 divided by 0.6 is equal to 1.67. And of course, 0.5 plus 1 is 1.5. Let me put all of that into our calculator. We are going to get 0.092 multiplied by 1.67 multiplied by 1.5. We get 0.2304. That indicates a 23.04 ROE, return on equity. There we go. Now, remember, we do still have to calculate the sustainable growth rate. We're not entirely done yet. We've just done this part of the question. We still have to calculate the SGR. With the ROE, that means that now for the purposes of the SGR, let's scroll down a little bit over here. For the purposes of SGR, we need another piece of our puzzle. So SGR equals to ROE multiplied by the retention rate, divided by 1 minus ROE multiplied by the retention rate. Now, in this case, we don't have the retention rate, but we do have a value for the dividend payout, right? So that means, once again, to the rescue. Here we're going to calculate our DPR. Our dividend payout ratio is going to be equal to 14,000. That's the amount of dividends given divided by net income. That's 23,000. So 14,000 divided by 23,000 gives us a dividend payout ratio of 60.86%. So 60.86% is our DPR. Retention ratio is going to be 1 minus our dividend payout ratio. So 1 minus that particular number gives us 0.3913 or 39.14%, in fact, with rounding off. Okay, 39.14. So we now have the ROE and we have our retention ratio. That means we can now plug it in. So 0.2304 multiplied by 0.3913. All of that is to be divided by 1 minus 0.2304 multiplied by 0.3913. All right, plugging that into our calculator, we get 0.2304 multiplied by 0.3913. And our numerator is going to be 0.0902. And for our denominator, we get 0.9098. And so dividing the two, we get 0.0991, or a sustainable growth rate of 9.91%. All right, don't forget to like and subscribe and drop a comment below if you have any further questions. Thank you.